8,000 is not wild. I mean, we were not that far below 6,000. When I first started calling for $5,000 gold, it was maybe about 1,500. Took longer than I thought to get there.
Yeah.
But it did get there. But now I think prices are going to head much higher. I mean, something like 20,000, would be, oh, that's crazy. Because at least that's way above where we are. But I think that's certainly something that might happen given the trajectory that I see us on as far as debt and inflation and where the price of gold would need to be given that. But, Wall Street is finally starting to notice that over the past 26, 27 years, people are better off in gold than the S&P 500. And so that tells you something.
Gold prices are moving along a trajectory that makes targets of $8,000 and potentially $20,000 per ounce increasingly realistic. While previous forecasts for $5,000 gold took time to materialize from lower levels, the accelerating pace of national debt and inflation suggests the next major repricing is inevitable. Wall Street is finally waking up to a critical long-term reality. Over the past 27 years, holding physical gold has outperformed the S&P 500, proving it to be the superior asset class for wealth preservation in an era of currency debasement. PeterSchiff, chief economist at Euro-Pacific Asset Management, emphasizes that these figures are not wild speculation, but the result of fundamental monetary decay. He notes that while the timeline for price discovery can be unpredictable, the destination is clear. As the dollar continues to lose purchasing power against real assets, the market is signaling that the era of paper asset dominance is drawing to a close. Now, we present the clips from PeterSchiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I believe should keep gold on the balance sheet as opposed to keeping dollars. I think it's a better store of value. So I think, companies that have a large cash position should think about diversifying that. I mean, either paid out in dividends, buy back stock, but, why leave it in cash with inflation eroding away the value? Much better to just hold it in gold. But it made no sense for any company to hold their cash in Bitcoin. I mean, that's just like gambling, taking it to a casino. What would be the point of doing that? I think that's reckless, disregard for your duty to shareholders to take, your corporate treasury money and gamble it on Bitcoin. I think ultimately, central banks would like to have no dollars and just gold, but it's just taking time to make the shift. Monetary policy may accelerate it. We go back to QE in a bigger way, more rate cuts. The U.S. gets into recession. Our budget deficits get bigger. All that I think would accelerate the flight from the dollar. 8,000 is not wild. I mean, we were not that far below 6,000. When I first started calling for $5,000 gold, it was maybe about 1,500. Took longer than I thought to get there.
Yeah.
But it did get there. But now I think prices are going to head much higher. I mean, something like 20,000, would be, oh, that's crazy. Because at least that's way above where we are. But I think that's certainly something that might happen given the trajectory that I see us on as far as debt and inflation and where the price of gold would need to be given that. But, Wall Street is finally starting to notice that over the past 26, 27 years, people are better off in gold than the S&P 500. And so that tells you something. Gold's just staying there. The dollar is what's going down, right? I mean, you used to need just $20 to buy an ounce. Up until 1933, you could buy an ounce of gold for $20. And then up until 1970, you could buy an ounce of gold for $35. Now you need $5,000. The gold hasn't changed. It's exactly the same as it was in 1970 or 1933 or whenever. All that's changed is the dollar. The dollar buys a lot less today than it did back then. So, 1970, you only need $35 to buy an ounce of gold. Now you need $5,000. It's the dollar that's losing value. Gold's not becoming more expensive. It just means that the dollar has a lot less purchasing power, so you need a lot more of them to buy the same ounce. It can depreciate a lot faster and a lot farther. I mean, it's just a paper currency. Its value is a function of confidence, and confidence can be lost very quickly. That's one of the main problems with fiat currencies. The dollar index recently hit a 4-year low, bounced a little bit. the dollar hit a record low against the Swiss franc. So that's a sign that it's going lower. But we haven't had a real dollar crisis yet. I think that's coming. I think gold is just an early warning sign that that's coming.
Corporations holding large cash positions are watching their capital erode due to inflation, making diversification into physical gold a fiduciary necessity rather than a speculative play. Unlike Bitcoin, which represents a reckless gamble for corporate treasuries, gold offers a stable store of value that has historically preserved purchasing power while paper currencies collapse. The dollar's decline is mathematically undeniable. What cost $20 in 1933 and $35 in 1970 now costs $5,000, proving that the metal hasn't become expensive. The currency has become worthless. This trajectory suggests that price targets of $8,000 or even $20,000 are not wild fantasies, but inevitable outcomes of current fiscal paths. With the dollar recently hitting record lows against the Swiss franc, the market is flashing early warning signs of a looming currency crisis. As confidence evaporates, the shift from fiat to hard assets will accelerate, leaving those holding paper with significant losses. Let's get back to the interview.
There was a lot of, speculation that finally came into the silver market. I think after it kind of broke through the 50 resistance area, the move from maybe 80 up to 120 was very swift. And then it had an even swifter pullback, down to the mid-70s. It was very sharp, basically happened in one day, but then it's been volatile. It's getting hammered again today. But I think a lot of this is just noise. I think the market has clearly broken out after decades of consolidation. And I think we're headed to much higher prices over time. Same for gold. Gold hasn't had nearly as much volatility because gold has had a more linear path. It's been gradually rising over the years. Silver kind of went sideways. Then silver had to catch up, and it kind of caught up and then overtook gold. And so now it's kind of probably back in line. Central banks have lost confidence in the dollar, in the U.S. government's commitment to maintaining its value and getting a handle on its fiscal house. And I think they've made a decision to move on, and they're clearly moving to gold. That is the replacement reserve asset for the dollar. It's gold, and that's why they've been buying it. That's why they're going to keep buying it. And I think this is a significant game changer for the global economy, most importantly for the United States. Well, I think gold's going to keep moving, and I think that you're going to see a continued exodus of capital out of U.S. financial assets. So you're going to see that underperformance of U.S. stocks relative to global markets. And I think you're going to see the same thing in economic performance and living standards. I think the U.S. is going to suffer during this transition. And I think the rest of the world will prosper because they no longer have the burden of subsidizing our economy. We lose the benefit of that subsidy, but they lose the burden of having to provide it. The whole sector is undervalued, and maybe Wall Street will start crunching the numbers again after the next quarterly earnings come out, so much better than what had been expected. Maybe they'll start raising guidance, but even the companies are reluctant to base their guidance on these numbers. So they take a more conservative approach that the prices are not going to hold up. Everybody expects the prices to come down. Not only are they not going to come down, but they're going to keep going up. So the stocks are significantly mispriced. And I think the juniors are mispriced relative to the majors. We have a nice exposure at my gold fund. So a great way to get into it now and to get exposure to those small stocks is by buying my gold fund with Euro Pacific Gold Fund. The no-load symbol is EPGIX. You can buy that at any discount broker, or just go to my website at Europac.com. You can buy it there, or you can talk with our representatives. Not only can you buy the funds through us, but we do have separately managed accounts if you don't want to be in a fund. We manage portfolios that are, precious metals mining portfolios. We also manage broader portfolios that seek out growth and income in other stocks. But we do have specialized strategies specifically for the miners. You look at what's happening with silver demand for batteries, AI generating demand. So, demand is a big part of price. And a lot of the demand, of course, is byproduct of inflation. But then you've got the supply constraint. there's a limit to how much silver can be mined. So metals are a lot different, let's say like agriculture. If soybean prices go way up, farmers can stop farming corn or wheat and plant more soybeans, right? And try to increase the supply of soybeans. But if there's a big increase in the demand for silver, they just can't start pumping out more silver. I mean, if they would already be mining it if they had it. So it's going to take a long time and much higher prices for the market to respond to higher prices with additional supply. Silver is going to be more influenced by the industrial use because it's used more in industry than gold. Not gold could be used more if the price wasn't so high. But because the price is so high, it's used very sparingly. I mean, the main industry, obvious, is jewelry. But there are a lot of other applications where gold would do a very good job, but it's just too expensive. So they use silver, copper, or some other metal. Gold is more of the pure monetary metal. I mean, it's the metal that the central banks are holding.
Right.
That's why, for example, like silver's down 12% today with the margin call related liquidation, but gold's only down 2%, right? So gold is a lot less volatile. Strategy is down 80% from its peak price. But what's probably more significant is Strategy has spent the last 5 years buying Bitcoin. They have spent about $54 billion buying Bitcoin. And the Bitcoin that they own is now worth about 13% less than what they paid. That is the horrible investment result for 5 years of buying. And the losses just keep piling up now, especially if they keep buying Bitcoin, which they seem to do every week. So that really shows you, because the reason that Strategy was able to raise so much money to buy Bitcoin was because the people who were buying Strategy stock wanted exposure to Bitcoin because they thought it would have this great return. And they were wrong. The return on Bitcoin has been lousy the entire time people were buying MicroStrategy. Now, MicroStrategy stock is still way up since they started buying Bitcoin because they've been able to create so many shares and use it to purchase assets that still have value. So that's what's propping up the price of Strategy stock. But as the air comes out of the Bitcoin bubble, it comes right out of the Strategy bubble too. And Strategy ultimately is going to trade at a very significant discount to its Bitcoin. So there's a lot of downside risk in Strategy right now, even more so than there is in Bitcoin. There are gold ETFs already, but I don't see there's like a gold treasury company that says, hey, we're going to start a business and our business is just to buy gold. I mean, that's not a business. I mean, anybody could just buy gold. The point of the ETFs is just that they store it for you. They make it more convenient to buy gold. But, I don't know. Nobody would do in the gold space what Strategy did in the Bitcoin space. And the whole thing that made this crazy scheme seem viable was that the market at the time was willing to assign a premium to a company that decided they were going to be a Bitcoin treasury company. And so that's what made the whole thing possible, because if your stock is going to trade at a 50% premium to your Bitcoin, you just keep issuing shares and buying Bitcoin. And you end up getting, all this free Bitcoin because you sold $1 worth of stock and you ended up with $1.50 worth of Bitcoin. You got 50 cents for nothing. But eventually that 50 cents is going to be nothing because Bitcoin is going to be worthless.
The recent volatility in the silver market, witnessing sharp corrections from $120 down to the mid-70s, is merely noise in a broader breakout trajectory. While gold provides a linear hedge as central banks explicitly abandon the dollar, silver's path is dictated by a severe disconnect between inelastic mine supply and exploding industrial demand from AI and battery technology. Unlike agriculture, where farmers can rapidly plant more crops to meet demand, silver miners cannot simply print more metal, ensuring that the supply lag will sustain significantly higher prices. This tangible value contrasts sharply with the reckless nature of corporate Bitcoin treasuries. Companies like MicroStrategy are trapping shareholder value in a speculative bubble, with holdings now worth 13% less than their cost basis despite billions in capital deployment. As the premiums on these speculative stocks evaporate, the smart money will likely rotate into the deeply undervalued gold mining sector, where Wall Street is ignoring real earnings. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.